All right, in this session, we want to get into professional liability insurance, also known as errors and omissions insurance. This is not insurance. I've never worked for a company that actually sells this insurance. I certainly had this insurance on me personally. As an employee of USAA, as an officer of USAA, I had exposure to our 401k plan, our pension plan, and other employee benefits, also as the portfolio manager for mutual funds. If I made a mistake, made an error as an officer of the corporation, then the members, the participants in the 401k plan, the participants in the pension plan, or stockholders in the mutual fund could sue me personally. And so USAA provided me professional liability, or in that case, directors and officers insurance. So it's insurance for those who have special skill, who are making decisions that impact other people, and it's insurance in case they make a mistake. I want to specifically look at medical malpractice because it's one that's been in the news, especially the last 20 years. So it covers obligations arising out of professional services, malpractice, errors, or mistakes. I'll let you read through the notes in here, but this common occurrence, when is an occurrence that can be extremely important? Are you insuring someone from the time that they realized they were exposed? I mean, from the time they were exposed, whether they realized it or not? Are you only covering them from the time that they realized that they had a problem? So asbestos, we'll talk a little bit later. People might have been exposed to asbestos back in the 70s, but they did not get cancer until the 80s or the 90s. So the exposure doctrine says the insurance company that had the policy when you became exposed to asbestos is the one who's covering you, not the insurance company that was insuring that entity when you became aware that you had the cancer. Same thing with medical malpractice, especially doctors who work on maternity and helping with the birth. They may do something that's not discovered for years later. Something happened at birth that caused some kind of learning disability or some kind of physical problem, and it may be years later. The exposure doctrine says it's the doctor, the insurance company covering the doctor at the point in time that he delivered that baby. That's the insurance that will cover him, not when years later they discover that the child has an issue. So it's important. These are pretty huge issues. We're not going to get into claims made in occurrence, but just realize when a doctor changes insurance companies, there has to be some acknowledgement that that insurance is going to cover him not just for the mistakes he makes going forward, but even covers him for past mistakes that may not manifest themselves until later. And that's the retroactive date. So the insurance company says, okay, we cover you for anything you do going forward, anything you do wrong going forward, and anything you did wrong the last 10 years that may not manifest himself until the future. So you want a really long retroactive date. I've spoken to doctors, and it's fairly standard that the retroactive date always goes back to the first day that they actually started practicing to make sure they're fully covered, because it can be a long, long time before you discover those. So that's professional liability, especially doctors for malpractice. It can also relate to legal works. If you're an investment person or a financial planner, I actually think financial planners have some risk here. And actuaries, if you're, actuaries, CPAs, finance, if you're working for yourself in your own office and you're worried about some decisions you may make that might cause someone a loss, then yeah, you'd want to make sure you have coverage that covers you from the time you started your business. All right, so let's jump to another special issue. Before we do that, just a real quick overview on commercial general liability. It protects the insured against liability rising out of their premises or their operations. So if they have employees going off premises, it covers them there. Covers them for bodily injury and property damage, defective product or services of the insured, and the typical torts: false arrest, malicious prosecution, etc., libel or slander, violations of personal property. It covers medical payments. So it's a fairly broad. I think the key here is, unlike homeowners insurance, it covers something very specific related to defective product and services of the insured. So if you're selling a product and it blows up, I know I forget the name of those boards that people were on, like skateboards, were catching on fire, things like that. They can certainly cause huge liability losses. This insurance will cover that type of risk. All right, there's a few articles I gave you. I don't know if you need to really read the articles. I do have some of them are highlighted. You might glance through them. I think I can cover them pretty well in the class notes very, very quickly. They're issues related to just the growth and liability issues, and then a special issue of asbestos. And so let's start with the first article. It's called Tort Update. It's very old. It's been around for many years. I just cannot find a better update. Much of the stuff in this article is still true. The biggest issues, we'll cover it in more detail, but the biggest issues are that liability costs are growing really fast in the United States, faster than the whole economy, and that this is a very unique issue to the United States. We're a very litigious society. So that's the first article. The second article, and we'll get into the first article and what it talks about. The second article is what tort reform is all about. And so we'll get into that. What did they mean by tort reform? And then the third article is on asbestos. So we got a couple articles on asbestos. The second group of articles is actually a few articles combined together, and then the last article on asbestos. Asbestos is a good one to talk about with general liability because it was such a huge issue, put several companies out of business, and because of that, it's still pretty topical. And in fact, we were talking about Berkshire Hathaway earlier. Berkshire Hathaway stepped into this market and went to one of the largest asbestos liability writers in the country and bought a big chunk of their asbestos business, and supposedly got a pretty good price for it. You know how Berkshire Hathaway is, and Warren Buffett. So it's recently been in the news. All right, so the tort update. First, a tort is a wrongful act other than a breach of contract. We already talked about that. This first article talks about how fast this liability coverage is growing in the United States, especially in medical malpractice, especially with asbestos. We're probably seeing a lot of D&O insurance here, with the market selling off 25 to 30%. Pharmaceuticals have been sued dramatically. It's amazing the hundreds of billions of dollars they are paying out in these type of lawsuits. Auto liability used to be the biggest one. This is where everybody was suing, but there's been a shift from the personal side to the commercial side. It's not as big of a deal today, probably because of some of the reforms going on, but probably because the others are just growing so much faster. There are some new risks out there. The health aspects of fast food has been one. I know the vaping has been another one. The electric cigarettes has been one. I do think investors and financial planners may be in some problem because we have so many people retiring. And if the stock market sells off again as it is this year and drops like it did in 2000 and then in 2008 and again this year, there may be people suing that they got bad advice from financial planners. We'll see. Anytime there's a group of people with a lot of large losses and they are all using the same industry, there's a good chance some personal injury lawyers will find that, create a class action suit, and sue that industry. I think it's very, very possible. Some definitions that they have in this article that are very important. ALE are those loss adjustment expenses. So you have claims, that's what you actually pay to the insured, but you also have loss adjustment expenses. Those are expenses that you have in order to research the claim, some of the legal work, the legal costs, the adjuster's costs. You may actually have actual employees going out to investigate. That's your allocated loss adjustment expenses. And then you have ULE, your unallocated, those are your costs that are not directly related to the adjustment process, but are allocated there. It might be 5% of the CEO's time or something along those lines. They talk about underwriting gain and loss and float, the same thing we talked about with the combined ratio. And they talk about the loss ratio. We talked about that before, losses divided by premiums, the combined ratio. So this article has some material that we saw early in the semester. A term they use in this article that we haven't touched on, it's the only time I'll really touch on it, is this concept of IBNR. Very unusual concept. Really only applies rarely in the P&C insurance area, and then in the life insurance industry related to health insurance. But incurred but not reported is very much what we're talking about with the exposure versus the manifest. Insurance companies have to set up reserves not when people report claims, but when people were exposed. So let's take asbestos, for example. If someone was exposed to asbestos in the 70s, but they get cancer in the 1990s, insurance companies have to set a reserve when the person was exposed to asbestos, not when they got cancer. So IBNR is very much a subjective statistical number, really a guess that firms do based on history and other things. But you will see this as a huge issue in longer tail lines like asbestos, like in auto insurance it could be if it's related to bodily injury, but mainly it's more pharmaceuticals and healthcare, medical malpractice, asbestos, those things that can take many years to manifest. Loss ratios, LAE ratios, we talked about those earlier. Expense ratios, anytime you see these ratios, you're just taking the losses, the LAE, the expenses, and dividing them by premiums. The loss and LAE ratio are divided by written premiums. Expense ratios divided by earned premiums. We might talk about that later in the class. I'm not real picky that we have a real clear distinction between those two, but we'll probably get into them a little bit. Already talked about the combined ratio, and then the trends they talk about, the fast growth in tort cost. What are tort costs? There's the direct cost that goes straight to the plaintiff. There are the defense costs to defend themselves. There's those administrative costs. And their numbers that they're showing in this report, they're excluding the tobacco settlements because that was such a huge deal that would have distorted the numbers. And then there's other indirect costs. The fact that we no longer do things in our society today because of these liabilities, these lawsuits. I remember when I was a kid, our playgrounds had these merry-go-rounds that boy, those things were fun. You could get people spinning really fast, but boy, were they dangerous. And so today you just don't see those in playgrounds anymore. So that's another cost, stuff that we just do not do anymore because we're worried about being sued. And in medical malpractice, we'll come back to this issue. There are issues of doctors that were actually cutting back on their services and getting out of the profession because of the high costs in medical malpractice insurance premiums, particularly baby doctors and children's doctors. It was creating a healthcare crisis. There were people who actually could not find a doctor because of medical costs, medical insurance costs. Insurers were getting out of the market as well, which causes doctors to leave. So it's somewhat of a circular problem. So what are the solutions? What is actually tort reform? I'll just let you read through these lists. The kind of things we count as tort reforms. Statute of limitations. You can't sue 50 years later. You got to sue within 3 years. They may put limits on lawyer contingency fees. We talk about punitive damages. They may put limits on punitive damages. They may put limits on pain and suffering damages. They may put some limit on how guilty the defendant actually was. Some of these lawsuits, they're not suing the person who was most guilty. They're suing the person who has the most money. And courts are now saying, hey, if you're secondary, you really were tangential to this entire issue, we're going to limit what you can be sued for. Some of them don't want lawsuits to look like a lottery, and so instead of giving someone a lump sum, they force the person to take out a periodic payment over the rest of their life. Some of them limit jurisdiction shopping. There are certain courtrooms that have a reputation for paying out really large claims, and lawyers tend to want to find one person in that jurisdiction and create a class action suit around the entire country, but sue in that jurisdiction because they have a favorable court. And so all they have to do is find one one plaintiff in their class action suit that's in that one jurisdiction. And there's starting to be limits on that. Deducting the insurance payments so that people aren't looking at how much insurance someone has and saying, hey, you have $1 million in insurance, so I'll sue you for $2 million. You pay me $1 million, and the insurance pay me $1 million. But essentially, they say, hey, you do your lawsuit ignoring what the insurance company is going to pay, and then the insurance will figure that out later. And then some states are saying, forget it, we can't fix it. We'll just create these state pools to help compensate defendants. So that's essentially tort reform. It's a really pretty good, pretty exhaustive list. You don't need to read all the details. The article itself goes state by state by state, showing what different states are doing. All right, so what I want to do in our last session for this class is talk specifically about asbestos insurance. Asbestos claims, a big issue in the United States. We'll go through that article. Not a whole lot there. There's some overlap with this and what we talk about with mold. And that will finish. We'll finish ahead with commercial insurance. In fact, I think what I'll do is the first session I did was a little bit long, and this one's running a little bit long. I think I'll make this our final for this class, our final session for this class, and I'll start asbestos insurance for our next class after that. Thanks.